Mullen Automotive has been a popular stock to trade so far in 2022. And in this video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we gotta be mindful about which positions we pick up, as well as their individual timing and exposure. Now, before the video begins, just quickly, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few weeks, and even month, Mullen has been having a relatively calm price action compared to the rest of the sector, and arguably the rest of the stock market as well. Of course, we're not at the point where the company had a major uptick by more than 100% anymore, but the stock has had its fair share of selling pressure, just like the rest of the market, and that it has managed to maintain its $1 level so far. With that being said, I think that one specific episode is very worth studying about its impact that it had on Mullen and what should we conclude from this point onward. A few weeks ago, Mullen announced that it's going to release a press release regarding working with a Fortune 500 customer, and that at the time, this information has created a lot of hype within the shareholders' communities. June 30th came and went, and Mullen didn't really disclose the name of the client. This has created a lot of turmoil online, resulting in a lot of skepticism and an increase of lack of faith in the company. I mean, for me, I think that the fact that it didn't disclose the name of the client is certainly bothersome. It's also not unheard of, because in my opinion, there could be many potential reasons why the company chose this course of action. For example, they could be asked to provide additional privacy for their client, or because the client may have their own considerations on a time-sensitive basis. The other aspect that I find curious is that for all the noise surrounding the lack of transparency and the lack of communication about a major release, that a company hyped up itself. And by the way, I'm not saying that they're blameless in this whole thing. They're very much for blame. But the curious thing is the stock price during that period of time, in the grand scheme of things, so if we look back, 2 years or plus, it didn't really move that much, whether it was up or down. And what this tells me is that a great deal of what could influence Mullen's stock price is actually the overall appetite for risk, period, and whether the stock market at large is ready to invest in the growth stocks once again. Now, with that being said, let's also take a look at the technicals of Mullen. The trading volume of Mullen Automotive has recently been 23 million shares versus an average volume of 58 million shares. Over the previous 52-week period, the price fluctuated between 52 cents and $15.09. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of a company. And when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance. Even when the current volume is lower than the average, it is an interesting indication because it may signify a trend reversal may happen soon. The market cap of Mullen Automotive is currently at $339 million compared to the enterprise value of $112 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles. They're not things that you can use to generate income right now, but they're essentially promises for the company's future growth, such as brands, intellectual properties, and schematics for new products. For some companies, most of their valuations happen to be based in these intangibles and valued in more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below its book value at the moment, but doesn't mean that the company itself is necessarily undervalued. It's also possible that a company itself has been overvalued in the first place and that it has been deflating back to where it was. As we compare the current price to the historical price fluctuations, the stock is 13% higher than the 1-month low, 35% higher than the 12-week low, and 96% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment, the implied volatility is 220% versus a historical volatility of 155%. The put-call volume ratio is currently around 0.3. It's normal for most stocks to have a put option volume higher than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 19,000 contracts a day versus the 30-day average volume of 42,000. In terms of open interest, the most recent volume of open interest has been 508,000 contracts versus the 30-day average 468,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract gives you the premiums, with the obligation to execute the contract should the counterparty do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio actually is. If most of people are buying the put options, there could be a possible uptrend on the move, or that a reversal could happen if there's a lot of call options expecting the stock price to go up. The reasoning behind that theory is very simple, as most people react too late to something that has already happened, and most options contracts as a result do expire worthless. In terms of shareholder structure, institutional shareholders own about 2%, or 1.6% to be more specific, of the current outstanding shares. The biggest shareholders include Citadel, Vanguard, and Susquehanna International. It's relevant to understand the shareholder composition of a company, as this helps to determine if you should hold the stock long term or to view it simply as a trade opportunity. If the stock is mainly held by retail traders, this could be a sign that the stock lacks depth to justify long-term trust from shareholders. The consensus is that typically there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment. In other words, I wouldn't say that Mullen is a stock that I would really hold for the most part for years to come, right? So far, it has been a speculative stock for people thinking that they can make a quick buck. So this is why, as long as the company doesn't show to the market that they can put up real products, that they can be a real player in this sector that has already plenty of fish and also plenty of challenges, I think this situation is going to continue. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume, and this could be a sign that there's an organized shorting operation occurring, such as what happened with GameStop and AMC. The current short interest is 11% of the total float, with 48% of the transactions coming out from the dark pools. Usually, if the short interest is about 15% of the total volume, with a significant chunk of it coming out of the dark pools, this is a telltale sign that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation for Mullen is to keep investing in it by dollar averaging down over the next 3 to 5 months, and to keep an eye out for potential news releases that can trigger additional volatilities. I would recommend to commit between 3 to 5% of your portfolio in Mullen, and would also recommend to split the allocation in about 10 to 20% at a time in order to benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings. which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.